Hi everyone, my name is Wilson and welcome to Syfe Insights. For today, we'll be sharing more about dividend investing and we will help you to discover some ETF that might be useful in your investment journey. In view of multiple rate hikes in 2022, many investors are constantly looking for ways to construct their portfolios and prepare themselves. One possible way is to invest in income-yielding assets such as bonds or dividend stocks. Bonds tends to be safer asset for volatile times, but their coupon payments are usually lower than inflation. On the other hand, dividend stocks provide income and have an annualized growth of 3.7% as compared to inflation at an average of 2%. The growth of dividends are slow and steady throughout time and across different environments. This can be seen in the chart where dividend yielded a return higher than the CPI from 1957 to 2021, and even so in a high inflation period in the 1970s to 1980s. But most importantly, dividend investing provides long-term inflation protection and real growth for investors as compared to investing in treasury inflation-protected securities. Across decades, dividends have accounted for, on average, 40% of total returns. With the S&P 500 down 14% since the start of the year, investors who purely pursued capital gains would have been disappointed with their returns. Investors who were invested in companies that consistently paid dividends would have padded their capital losses in a downturn. Over the span of 64 years, dividend investing has proven to be resilient in light of volatile market conditions. They are less volatile than your usual stocks, and the growth of dividends have declined only 6 out of 64 years, of which we only saw a decline in dividends of more than 10% during the 2009 financial crisis. Even though dividends do not provide exceptional returns as compared to growth stocks, during a high inflation period, dividend investing might provide investors with higher confidence to stay invested for the long term. It is also worth mentioning that historically, companies who had paid growing dividends over the years tended to also be companies who have had strong earnings and a healthy balance sheet. The ability to distribute growing dividends consistently sends signals to investors that companies expect its business performance to remain strong, which translates into significant investor interest and therefore capital appreciation. On top of the potential capital gains you may experience, dividends provide investors with fresh capital to reinvest. Compared to purely investing in the index, reinvesting your dividends could significantly improve your returns in the long run. In light of the market correction, a relatively low yield and an inflationary environment, dividend-paying companies might be better alternative for greater returns. To other asset classes like treasuries and bonds, although it should be noted that equities tend to carry more volatility. Investors who are looking to include dividend-yielding assets in their portfolio may opt to do so via Syfe Custom portfolios. Through Syfe Custom, investors may choose from 100 best-in-class ETF curated by our investment experts. Investors can decide on the portfolio allocation themselves and will be shown how the allocation fare based on past returns and will be provided with the sector breakdown. Dividend investing might not be something new, but it is a proven strategy that many investors fall back on during volatile times. The highlighted funds focus on dividends-paying strategies may be what some investors prefer amidst an inflationary environment. Investors should also take note of the associated risks while investing in specific sectors, so we hope this video has shed some light on how you can better prepare yourself and take action for your investment.